I wish everybody a good evening. I wish I were there to enjoy this event with you all. And unfortunately, circumstances have me grounded for a while. So I thank Zeifmans, and I thank all of you for giving me the opportunity to give my presentation as an invisible man.
Scott, just let us know when you want us to move the slides along.
Okay, so taking a look at the presentation outline, I'm just going to introduce a few business trends that we see as reflected in the advisory business that we receive in our Shanghai office from foreign entities that are either set up in China or cross-border transactions into China. And from there, I'm going to move into a brief description of what's going on with China's value-added tax reforms, and then from there on to the latest definition, which just came out for beneficial owner with respect to China's tax treaties and potential lowering of withholding taxes and so forth, and then a little discussion on withholding tax for non-resident entities that do business in China through cross-border transactions and so on. And then, of course, I will close. Next slide, please. Since the beginning of 2017, we've noticed an interesting trend in what's happening with foreign businesses that are set up in China. What we're seeing is dormant, wholly foreign-owned enterprises that are on the increase. And this is irrespective of what industry they happen to be in or what country the parent company of the subsidiary happens to be in, and so forth. And we're not really sure why this is happening, but nonetheless, we are now providing secretarial services to make sure that these dormant companies are in compliance with all the rules that govern businesses that are no longer doing business but remain registered in China. In concert with the increase in dormancy, we're also seeing an increase in liquidations. This year alone, we're seeing about a 3 times increase in the amount of business that we're doing, helping foreign entities to shut down their businesses in China, liquidate assets, and deregister. These liquidations are taking place on the manufacturing front. The manufacturing companies of interest here are those that in the past did manufacturing strictly for export to their parent companies or other clients outside of China. And some of the reasons that we have heard from our clients basically center around the fact that they can now buy the products that they were manufacturing. They can buy them cheaper from domestic Chinese companies who previously were potentially their competition. We're also seeing this trend with trading companies, mostly trading companies that were importing into China and selling in the Chinese market, and they're finding that the goods that they specialized in are now being manufactured in China at equal or better quality and better pricing. So they're just closing their doors and leaving. On the other side of the same coin, we see an increase in registration of representative offices, and this trend is mostly around companies that are not selling into the Chinese market but are sourcing goods from the Chinese market, and they need somebody on the ground to support them with negotiations on pricing and so forth, or to monitor quality control in their suppliers' factories and so on. Another area that we see the increase in RO registrations is around support for specialty equipment suppliers. We've seen medical equipment and supplies suppliers and specialty manufacturing equipment suppliers who need support on the ground but they're not doing their business directly from their Chinese entity into Chinese clients. They are still conducting the commercial parts of their business from overseas. Next slide, please. So with respect to the value-added tax reforms, these started in 2012, where at that time there was sort of a two-level indirect tax system where we had value-added tax for goods and business tax for services. Value-added tax, as you all may know, is collected by the seller from the buyer, and then the seller will settle up VAT with the tax bureau based on the difference between the VAT that they collect versus the VAT that they pay out during any given period. The business tax was a tax levied usually at 5% directly on the seller of services as this percentage of their total revenues for a given period. And so the desire was to do away with the business tax. A lot of companies found themselves trapped, being double taxed between the two systems and so forth. That's all cleared up now. All sectors of the service industry are now subject to VAT, and that includes representative offices, which do not participate in the VAT system in a traditional sense because they don't buy and sell goods or services in China. But they are subject now to the 3% levy rate that is also afforded to small-scale taxpayers in the country. VAT rates have been consolidated to just a few versus the 8 rates that there were in existence a couple of years ago. We have 17% for goods and a few services such as the leasing of properties or equipment and so forth. Then there's an 11% rate for the transportation industry and telecom or telecommunications industry, and 6% for pretty much everybody else. One of the things that we're disappointed about with respect to the latest regulations that came out earlier this year is the fact that there's no change to the language in the regulations regarding services that are provided to Chinese entities from overseas service providers. And we continue to try and help our overseas clients and so forth to educate their Chinese clients on this. Chinese clients and a lot of foreign-owned Chinese companies as well are still in the thinking way of the business tax days when they did have to withhold business tax from payments made overseas. As we all know, VAT is actually paid by the end user, but the language in the law doesn't actually make this very clear. So from our perspective, it's really important for anybody doing cross-border services into China to know what they're getting into there and how to work with their clients in China to make sure that VAT is not withheld but is actually paid by the Chinese clients. Next slide, please. Take a quick look at the latest definition for beneficial owner. Since 2009, this Circular 601 has been the document that has dictated how Chinese tax authorities are to look at intermediate entities or maybe not intermediate entities, but any overseas entities that claims ownership of China-sourced income. I'm going to use, in this case, Hong Kong holding companies as my sort of go-to example. And in the past, the Chinese authorities would look at a Hong Kong holding company and they would focus primarily on the substance of the business that is conducted by that holding company. And unfortunately, substance was not clearly defined. There was a list of items that would that were negative factors that basically said if you're doing this, then it's not considered to be substance and so forth and so forth. this lent a lot of confusion to people and has over these years. And so this year, the State Administration of Taxation released an announcement, number 9, which to the definition, I think, clarifies things and allows for a little bit more freedom for tax officials to make determinations that beneficial owners are, in fact, genuine. One of the things that's included in the latest announcement is the fact that substance can include anything from manufacturing, sales, and marketing, and so forth, to, I put quotes around, substantive management activities. And under the category of substantive management activities, it is allowed that just investment holding operations, for example, in Hong Kong, may have substantive business. What the Chinese authorities are going to look at, of course, is the risk versus function in these companies. So just to give a brief example, we've seen cases now where a holding company, let's say in Hong Kong, that consists of a post office box or a virtual office of some kind, is likely to be considered to have no substantive activities. But on the other hand, a holding company that has a genuine office sitting in Hong Kong, and that office manages investments in China, perhaps, as well as other countries, maybe Taiwan, maybe Singapore, and so forth, that type of company would definitely be considered to have substance and would thus qualify to be a beneficial owner, which may enjoy lower treaty rates that are afforded to Hong Kong as opposed to other countries. There are a few red flags, that are given in the latest announcement, and that is, of course, if a company does not control its own income, usually this is enough to disqualify the company from being considered beneficial owner, in which case the standard withholding rates would apply. And by not controlling income, it is delineated in the rules that if the company has to pay out 50% or more of its China-sourced income to another party within 12 months of receipt of the income, it would be considered to not be controlling its own income. Another red flag is related to loans or royalty agreements. For example, if a North American company has a holding company in Hong Kong, and the Hong Kong holding company is charging royalties to its Chinese subsidiary to be able to use a brand name, for example, and the Hong Kong company also has to turn around and pay royalties for the same purpose back to the North American company, this would be considered a piggyback royalty arrangement and would disqualify the Hong Kong entity as being beneficial owner of the China-sourced income. And of course, as in Circular 601 back in 2009, tax authorities are looking also at how China-sourced income happens to be taxed in the territory or country. And so they will definitely look at whether or not China-sourced income is tax exempt or very low, taxed at very low rates. And while this alone will not disqualify beneficial ownership, it is a red flag that definitely will get the Chinese authorities looking deeper into the situation. Next slide, please. Regarding withholding tax on non-resident entities, there's a lot that I could discuss related to the stuff I have written on this slide. I think I'm going to just limit it to the simpler things, and so that would include the fact that based on the 2008 enterprise income tax law, there is a 10% withholding tax that applies to all dividends, equity-related bonuses, interest, royalties, and license fees, and the leasing of immovable properties, all of these considered to be passive income. And if you happen to be in, if the beneficial owner happens to be in a country where the treaty rates are less than 10%, then they can enjoy those lower rates. I'm not going to go into the discussion of direct or indirect transfers of equity by offshore companies. This is an extremely complicated area of China taxation that requires, in most cases, a fair amount of research and discussion with the tax authorities that happen to have jurisdiction over the potential taxation. So I think I'll defer this to another time and move on to the withholding tax on cross-border service transactions. Now, here's a case where, like in the VAT case, a foreign company may provide services to Chinese clients. As long as the foreign company does not form a permanent establishment in China, and I show the listed number of months or days within a 12-month period here, as long as no permanent establishment is formed, in principle, and certainly as written in the tax treaties and so forth, there should be no withholding tax. The caveat here is that nothing in China happens automatically. So if treaty benefits, for example, no permanent establishment is formed, do apply to a given transaction, the benefits must be applied for. And so in this case, the application can be made by the buyer of the services in China, or can be made by some other representative of the overseas company. We do this kind of work for people, for example. In the event that tax is to be withheld, then there are several methods of calculation. Usually, the tax authorities will go for what's called a deemed profit, and deemed profit rates vary between 15 to 50% of the value of a transaction. Depends on what services are being provided. And so, let's say in the case of a $100,000 transaction and a 15% deemed profit rate, $15,000 of the money would be taxable at a rate of 25%, which is the usual corporate income tax rate in China. The buyer would then act as the withholding agent and so on. We believe that it's quite important that when negotiating service contracts into China, that at least some effort is made to ensure that the buyer will not only act as withholding agent, but will also handle application for treaty benefits if they apply, as well as all of the other issues around these types of transactions, and includes registering the service contract before the service actually begins, so it is clear as to how tax officials will interpret the transaction. And that pretty much takes me to the end. I just want to stress that for companies that have come into China and thinking that they can, how hard can it be? They can just do business the same way they've done everywhere else. We would like to discourage that kind of thinking. We believe it's very important that you get on the ground assistance, by someone who understands the rules and regulations in China and can help you plan your activities here accordingly. With that, I thank you for your attention, and I will invite questions if I can hear what's going on there.
Okay, so what we're going to do is, if anybody has a question, put up your hand. Tanya will bring you the mic so that Scott can hear the question.
Does anybody have any questions? Nobody? Brian? No?
Okay.
Good? So, Larry, if you just want to thank Scott.
Yeah. Oh, Scott, thank you so much for doing this, and wishing you a speedy recovery.
Thank you.